Have you ever sold a stock and then watched that stock go up in price only to realize that you could have made even more money if you had just held on? Today I'm going to look at one way to correct this. I'm going to share a simple method that'll help you never sell a winning stock too early ever again. I'm going to use Nvidia as an example because that's a stock that a lot of people are familiar with and you've probably heard about it at some point. So let's just assume that you found the stock in the beginning of the run back in January and you bought the breakout at $54 a share. You bought 100 shares of Nvidia at $54 a share and you were happened to be really early. So that's $5,400, $5,400 is where you bought it. You wait and you ride it out watching the price go up and up, and eventually the stock hits $84 a share back in this spike high here after their earnings. So we've got their earnings that drive it up even farther, and you're like, oh well, this is a pretty nice gain. I don't know how long this can last. I might as well lock in some profits and take my profits while I can, right? It's pretty smart and it's a good thing to do, lock in profits. But let's say you sell the whole thing. So you sell 100 shares and you get a 55% return or $3,000 on 100 shares, right? So you made $3,000, 55% return. It's pretty good. And the key thing is you made $3,000, you locked in your profit, everything's hunky-dory and great. Because, we never know how long the stock can go up, right? So, and then you continue to watch the stock and it goes sideways and you're like, oh man, that was a great decision to sell there because the stock is going sideways and I'm maybe right. The stock's going down. It goes down even farther. And you're like, oh yeah, that was just a great exit there. Pat yourself on the back. And then what happens? It actually reverses and it goes higher. It breaks out again on another earnings report. Gaps up. And then you're losing hundreds, thousands of more dollars that you could have made on this if you just held it a little longer, right? And it happens to everybody. And this feeling you get here can be worse than the feeling of actually selling for a loss. And say the stock had gone back down to 40 and you sold for a loss. That feeling sucks, but in my experience and many others, the emotional effect of having a stock go up higher and missing out on gains is even worse than losing money, which it's funny, that's how the mind works, especially for us traders, So the way to fix this is just simply this thing called position management, where you sell off in tranches or parts at a time, basically. Like a tranche is just a piece of your position at a time. So you have 100 shares of stock. Why would you sell 100 shares all at once when you can sell partial positions multiple times while still capturing the price increase? Well, you might say that, what if the stock goes down? Well, that's true, the stock could go down, but you can always cut your loss. You can always sell 100 shares or 90 shares or 50 shares all at once if you wanted to. You can cut the loss pretty quickly, and there's no reason to cut the gain quickly when we never know where the top is going to be. So all we're doing is using uncertainty to our benefit by expecting the stock to go higher and higher above our sell price, because it's almost impossible to top tick the stock price, right? So this can be used even in day trading or really long-term trading, whether you're an investor or just a trader. This can be beneficial to everyone, especially when you have lots of shares or lots of contracts, whatever you're trading. It's just the best way to really get out of a position while still capturing the most of the return that it has. So back to our example here. Let's say we do it my way. and what I would say is the best way, what it works for me at least, is just to conceptualize it in fourths. So you sell 25 shares 4 times, so that's 100 shares. So what I'll do sometimes is if my position goes up faster than I thought it was going to, let's say in this example, just as a wild example, let's say Nvidia in January and February went up to like $115 a share. Like at the end of February, it was already at $115 a share. It just went straight up, all month, like gap up after gap up. Well, if it's going up that fast, and I was expecting not even that great of a return by holding the position, I'm probably gonna sell at least half of it. So I'd sell 50 shares to lock in the profit. The most important thing when you're trading or investing is to lock in the profit, right? We don't want to hold the stock and never sell it and then have it go down and then be like, oh man, like it's actually lower than you bought it, because that's actually the worst thing that you can do, is never take profit. So if you have a gain, you must protect the profits. And the best way to do that is by scaling out using tranches, position management, like I'm discussing here, where you do take partial profits, at least along the way, so you can cut your loss and still come out ahead. So let's say the stock did go up to $115 a share in February, just as a wild example, which could have happened, you never know. Let's say it was for some reason highly shorted. It could have had a high short interest and just spiked for days after days. So I would have sold at least half of it. Maybe I probably would have sold 75% of it, or maybe even 80 or 90, if it goes up that much, that fast. But let's say you just sold 50% of the position, then you still have 2 more 25 share tranches to sell. So you can wait and see what it does, and you can always adjust your stop loss too, like your final stop loss, how much you're willing to profit. Because once you have some shares locked in and profit locked in, it's a lot easier to manage when you're already making money on that position. So let's go back to the basics here and say that it didn't spike up, and let's say that we're going to trade this as it was happening, which is pretty reasonable to sell in 25 share tranches at a time. So let's say we sold 50 shares at $84. So that's $4,200. It went all the way up to $84. And we thought, hey, that's a great run. I've got 100 shares. I'll just sell 50 shares at $84. So that's $4,200. Then you wait and wait, and stock keeps going up. You sell 25 shares at 110. So that's $2,750. And then you sell 25 shares at 130 because you're like, oh, this is a huge gain. Gotta take off the rest. So you sell 25 at $130 a share. So that's $3,250. So that's $10,200 just because you held on past that initial $84 where you would have sold all the shares if you had just sold 100 at a time. So by selling 25 shares at a time, you gave yourself the ability to capture more of the move. And this is just a best case example, of course, because the stock kept going up and up, but it's not unreasonable for a stock to even go up, another $10 a share. So maybe the stock went to like $90 or $100 a share, and that gave you an opportunity to sell more. So you sold another 25 shares there. Well, then you can set a stop loss just above your previous exit, or even you can set a stop loss lower, and you'd still come out with more than just selling all the shares at once at $84 a share, because you did sell some for higher prices. So sometimes I do sell half of the position at a time. It kind of depends on what you're expecting and what the market is doing too. So sometimes there's just a really low probability. There's just a low chance that the stock's going to go up a lot more. So you might sell 80% of the position and then sell the rest, 10 shares at a time. So the other thing this does is it gets you in the mindset of locking in profits. Taking profits is essential. So what this does is when you think of it as getting multiple times to take profits, you can take profits quickly initially. So you want to be taking profits when you get them. If you get a quick profit, you take it, whether it's 25% at a time you take off, 50% of the position at a time. But the idea is once you get a profit, with this method, you can take profits instead of waiting and then missing out on that profit. Like I said before, where it goes against you. That's just the worst case. The worst thing that can happen is you buy a stock, it goes up, you have a paper profit, you don't sell, and then it goes down and you lose everything and you sell it for a loss. So what you want to do when it goes up the first time, when it goes up, you sell a little bit. That way you've got some gain and you can adjust your stop loss, so you'll still have a profit when you sell if it goes below your stop loss, if that makes sense. It's pretty simple, really. It just gives you more control over managing your position, and I hope that explains at least how I approach position management. It's just the simplest way to do it, and you can use technicals to figure out where you're going to exit, like I do, or if you're an investor, you can use fundamentals. You can look at the valuation ratios. You can look at whatever valuation ratio you're looking at, like price to free cash flow. Once it hits 30-40 times free cash flow, well, that's pretty high for you, so you start to sell. But of course the market could decide to keep it going longer, so maybe it goes up to 60 times free cash flow. But by selling half of it at 30 times free cash flow, you're able to capture the rest of the market return, because even though the valuation's full, we know that the market can keep going past your initial valuation, because things change in the market or in the economy or something. So that's just the way to look at it, and that's how I initially found out about this, from investing, really, where I would buy a stock as an investment, it would go up and I wouldn't sell any of it, and it would go back down and you miss out on everything. But if you do sell at least some of it when it goes up, you can structure the stop loss or your exit to still walk away with a profit. So I hope this has been helpful and informative in helping people manage their positions and avoiding that shoot moment where you just watch a stock go up way higher than you had sold. So thanks for watching, and protect those profits.